Investors, we have everything from new employment numbers to a brand new inflationary reading, a cooling in the economy, and interest rate hike fears to break down today, all of which means that you as an investor should pump the brakes and remain cautious as 2023 unfolds. For those of you new here, I'm Ari, a value and dividend investor on YouTube, here to help you reap more success by way of sharing stock market insights and stock ideas. Now today, I want to keep it simple and cover an account update, share everything that you need to know economically, and finally leave you with 7 discounted dividend stock ideas that you should be adding to your stock watch list immediately. But before we dive in, if today's video delivers value to you in any way, please let me know by tapping on that thumbs up button. And from there, if I've earned your trust when it comes to stock ideas, tap on that subscribe button to join me on this very mission of reaching more dividend investors. With that, let's dive right in. So first and foremost, the account update, because after all the momentum this week, my account is now sitting at a nice high of $112,770.14. But because there is always a but, I'm not going to be too surprised if we're hit with some volatility and soon, and my account slides. Why? Because it always comes down to the macros. So first, it's incredibly important to take note of our last employment report. As of 2 Fridays ago, the data showed 236,000 jobs added to the U.S. economy, and the expectation was that we would see 239,000 jobs added. Now this means that we opened up last week after a long holiday weekend with pent-up excitement to invest, along with confidence to do so, because the data pointed to a cooling in the economy. What the Fed has been trying to ensure happens now appears to be happening. But that was not all that happened. We had the latest consumer price index or inflationary reading reported, and it rang in even more good news after economists expected inflation to come in at 5.2%, yet the actual CPI report read 5%. Once again, we saw more rallying. And last but not least, every single Thursday, we get a rolling report of initial jobless claims that essentially depicts how many new unemployment filers we had, and this past Thursday was a larger than normal sum. Which may sound bad for you and I, and it is, because who in the world would be rooting for higher unemployment? Yes, this guy. No, not the Joker, Jerome Powell. Powell and his gang at the Federal Reserve. Now, they are essentially trying to raise interest rates high enough to slow the economy, which would ultimately help chop down inflation to what will hopefully become their 2% inflationary goal. But that will all take time, and in that time, businesses will inevitably suffer from higher interest rates. So that's all I'm saying, is that we are likely going to be living in an environment of higher inflation and higher interest rates for some time, which will eventually cause sector by sector layoffs and a very scary recessionary environment for all of us. Now, the good news from all of this, opportunities galore in the stock market, and heck, all of these opportunities are even presenting themselves now, which leads me to our first dividend stock of the day, Deere. John Deere, that is, ticker symbol DE. It's a manufacturer of agricultural machinery as well as heavy equipment, various engines, and lawn care machines that, given the nature of our economic environment, has slid on the year to a share price of $380 per share, down by nearly 10% year to date. And while that may seem expensive, when value is what you get, Deere delivers as a $111 billion market capitalized industry leader with a PE ratio at just 14, prompting smart money to begin making money moves into the company with new investment positions, whereas analysts are also forecasting almost 25% worth of growth, coming to a share price of $473 per share. Again, this is contingent upon an economic turnaround, but rest assured, in due time, Deere will help harvest a nice return for investors, and until that turnaround comes about, shareholders will enjoy a dividend yield coming in at 1.24%. Moving to our second dividend stock, I want to talk about Aflac, ticker symbol AFL, which is the largest provider of supplemental insurance in the United States today and has come a long way since its founding in 1955, now insuring over 50 million people worldwide. And with a sizable $39 billion market capitalization, it's likely that this insurance provider will continue to grow even larger over time. But Aflac gets a mention today after its share price has been sliding over the course of the year. As you can see, it's peaked around $73 per share, now down to around $65 per share, down by nearly 8% on the year, along with a PE ratio coming in at just 9.9. And in my opinion, with more market uncertainties ahead of us, an investment into an insurance giant like Aflac is wise considering the business model. Now, analysts seem to have a similar outlook as well, with the share price rising to $73 per share, which is over 11% worth of upside to come. And until then, shareholders of Aflac will be able to collect on an above sector average dividend yield coming in at 2.46%. Up next, let's chop up or rather break down Tyson Foods, ticker symbol TSN, which, if you've been following my channel, has been mentioned quite often recently. But in even better news, it's now gaining that momentum that I've been alluding to after each mention. Anyhow, Tyson is the world's second largest processor of chicken, beef, and pork, and is what I consider to be an ideal investment right now, because if we do experience more economic volatility, consumers will likely look to buy cheaper meats. But if the economic conditions get better, Tyson will benefit from the price of animal feed and overall transportation expenses going down, making this $29.13 billion market capitalized industry leader ideal if you're looking to beef up your portfolios for the longer term. And as of right now, Tyson is still trading for a rather low price of just $62 per share, down from a peak of $92 per share from this time last year. That's over 31% worth of a change, along with a PE ratio at a low of 8.9, which is why I believe Tyson is seeing more and more hedge fund activity. Regardless, I do expect a rebound from Tyson, and eventually I will be selling, but enjoying the dividend until the rebound, given Tyson's dividend yield at 3.03%. Jumping to our fourth dividend stock today, I want to break down Amgen, ticker symbol AMGN. It's a biopharmaceutical company that actually doubles as one of the world's largest independent biotech companies, with a current market capitalization of $133 billion. Yet, similarly to some other biotechs, it's down on the year by a little over 3%, trading for $251 per share, which may cost you a little bit more, but the safety and reliability of a return is going to be worth the investment, with that PE ratio still hovering around 20.7. Now, looking ahead, analysts foresee upside with that share price rising back up to $264, a little over 5%, which is likely why we see smart money investing more into Amgen to hedge against future market volatility. But the best part of Amgen is the dividend, with an above sector average yield coming in at 3.24%. Next up, Packaging Corporation of America, ticker symbol PKG, which may sound quite obvious as to what exactly it is by the name, but before I get to that, I want to share a little story. You see, it wasn't too long ago that I was walking in Miami with a very wealthy business owner who shared some insights into building wealth. He said, "You know, Ari, everyone is always trying to invest into the latest dot-com era-like piece of technology, but as for me, I keep investing into what is boring, because most of the time boring is more lucrative over the long term." And with that, an investment into Packaging Corporation of America is a company solely focused on packaging, whether it's the containers themselves or the packing peanuts within. But what a lucrative play given the sheer necessity of packaging. And with an industry leader with a $15 billion market capitalization that also has a share price sliding over 5% from this time last year, trading for $142 per share, and likely to slide more before a rebound, keep focused on this one, especially with an already low PE ratio of 12.8. Of course, looking into this year, it could experience more trouble based on supply and demand, but in terms of a dividend investment, it has a beautiful yield coming in at 3.5%. Now, coming in at dividend stock number 6, a stock that I am a little reluctant to share, only because powerful growth really isn't there. But for our trying times, perhaps if you're looking for some real safety, then Verizon, ticker symbol VZ, is a solid bet. Verizon, as you probably know, is the most popular branded wireless operator in the United States and currently dominates the wireless network market as a $164 billion market capitalized telecom industry leader. It's way down from this time last year, over 22%, trading for only $39 per share, with a PE ratio coming in at just 7.8, which is likely why we see plenty of hedge funds pouring millions of dollars into this position to pad up their portfolios, while analysts also look into the future and see plenty of upside, over 18% worth of it, coming up to a share price of $46.33 per share. And until then, a rock solid dividend yield can be collected on, coming in at 6.61%. And last but not least, EOG Resources, ticker symbol EOG, which is a leading energy company engaged directly in hydrocarbon exploration, and as of recent was ranked 186 of the global Fortune 500 companies, which speaks to its dominance in leadership in the industry alongside its $70 billion market capitalization. However, amidst all of this market volatility, we've seen EOG slide on the year, whereas it was once trading for $134 per share, now trading for $121 per share, and could see some more downside, but heck, a PE ratio at 9 It's looking pretty good, along with smart money all over this position, loading up on shares, and analysts that are very optimistic about the future, forecasting a share price of $149.53 per share, which is over 22% worth of upside. But the real power for the long-term dividend investors when it comes to EOG Resources is the dividend, with a yield coming in at 7.34%. Now there you have it, investors. From John Deere, Aflac, and Tyson to Amgen, Packaging Corp, Verizon, and EOG Resources, the 7 dividend stocks are ripe for your investment, or at the bare minimum, and add to your stock watch list. Now please keep in mind that you should always be doing your own due diligence before adding any of these positions to your portfolio. But seriously, let me know what you think about any or all of these positions down in the comments below. And if this video brought you any value, let me know by tapping on that thumbs up button, while also subscribing for more videos just like this one. And with all of that said, investors, I will see you all in the next video.